In this example video, we are going to go over review exercise 4-7, and we're going to take a look at how we put together the intangible asset section of our balance sheet. When we're talking about intangible assets, these are assets that you can't necessarily see or touch, but typically have a significant value to businesses on their balance sheet. So these are going to be things like patents and copyrights and trademarks and goodwill. All of these types of things, you can't necessarily see or touch, but it's providing a lot of revenue source potentially for that business. So for example, if a company owns a specific patent, that gives them the exclusive rights to sell a product or service that has at least one unique feature. So that could be a big revenue generator for that business. Certain trademarks for companies become their symbol that associates their product or service with their brand. So you think about the golden arches, for example, for McDonald's. That is a very valuable asset to the business by having that trademark. So we list out those intangible assets individually in this intangible assets section. So they provide us some information that the Glenda Corporation has the following assets. We have our prepaid rent at $6,000, land at $58,000, trademarks, computer software cost, patents, inventory, and goodwill. And again, we're going to put together that intangible assets section. So taking a look at the items listed, prepaid rent, definitely not going to be an intangible asset for us. Prepaid rent would be a current asset. We plan to use that up pretty quickly, typically within a 1-year time frame. So that is not going to be an intangible asset for us. Also not going to be an intangible asset for us are the inventories. Inventories also a current asset, the inventory that we plan to sell to our customers. So we're going to start off, and we also would use our land. We know land is a fixed asset, not an intangible asset. So it's something that we had around for a while. We can physically see that piece of land as a tangible item. So we're going to start with our trademarks. So again, think about the golden arches, the Nike swoosh sign. All of those things would be considered a trademark to a business. We also have a patent of $13,000. So if you ever watch Shark Tank, one of the first questions that one of the sharks usually asks somebody that comes in is whether or not they have a patent on their product, giving them those exclusive rights to sell that product, or if they have a service, sell that service. We have computer software cost. That would also be an intangible asset for us in the amount of $8,500. And finally, goodwill, and our goodwill is at $11,000. Again, when you're thinking about goodwill, what goodwill is, it has to be a measurable, recordable transaction, and it has to be something that's intangible that you're paying extra for. Goodwill typically is generated by acquiring another business and paying more for that business than what their net assets are worth. And those net assets are those assets minus your liabilities. So if we're paying something above that price to acquire a business, typically companies are doing that because that business they are acquiring has something intangible that the company wants. For example, it could be a prime location. It could be a market share of the customer base. It could be brand loyalty. It could be quality management. All of these things we're willing to pay more for of $69,500.